Hello and welcome to Market Domination Overtime. Stocks closing today mixed. Let's send it over to our very own Jared Blickery at the big monitor with the latest moves. Jared.
Thank you, Josh. Another day where the fortunes of the Dow and the NASDAQ are opposite each other. Today, the Dow is up and the NASDAQ is down. Let's start with the Dow. It's up about 55 basis points, half of 1%, or 269.54 points. And you can see pretty close to the highs of the day, just kind of traded in a range most of the afternoon and a little bit of the morning as well. Here's the NASDAQ composite, stuck in the red all day long, finishing the day up just under 0.5% in losses. And then the S&P 500 barely positive, but I'm going to call that unchanged here. And the S&P 500 equal weighted index outclassing them all. That was up 88 basis points. That tends to be up as on the days that when the Dow is up as well. And I do have to celebrate a record high here, and that's for the small caps. Russell 2000 index, that is at first record closing high of 2026, and you can see it's up 1%. So nice showing for the small caps there. Also micro caps putting in a nice performance, up about 0.75%. Let's go to the large cap sector breakdown, where we have energy up 3% here. That is the best day for energy since April 9th, 2025. That was the everything rally after the post-Liberation Day sell-off that kind of saved the day there. So energy up quite a bit. After that, staples, materials, and consumer discretionary. Those four sectors all up more than 1.5%. A nice showing there, and a pretty broad mix as well. Tech did not do well today. That was down 1.5%. And healthcare, which has led periodically this year, that was down about 86 basis points. Now let's take a look at the NASDAQ 100. Kind of ugly in mega cap land, though we do have some standouts. Alphabet, Amazon, Tesla, each up more than 1%. Broadcom down more than 3%. And in fact, if we take a look inside the chip sector, we're seeing a bit of dark red there. Not only Broadcom, but Micron, Applied Material, Intel, all those down more than 3%. Western Digital down more than 6%. And then over in software, we also have a bunch of dark red, a few green names like IBM, that's up 2%. We'll take a look at the Dow to close things out here. But Snowflake down 4%, CrowdStrike down 3%, and Datadog and Atlassian, each of those down 7%. Promised the Dow, so let's get to that. And aside from some of those mega cap names I already reviewed, we're seeing a lot of green here. Home Depot up 3%, Honeywell up nearly 3%, so is Sherwin-Williams, American Express up 1%, Chevron Energy up about 2.8%, and Procter & Gamble on that Staples trade, that was up 2.5%. So Dow looking pretty good today. The NASDAQ not so much, Josh.
All right, thank you, Jared. Well, strategists project another bullish year for U.S. markets. Investors should also be looking beyond domestic equities so as not to miss out on the opportunities lying within the international arena. Portfolio manager of the Parnassus International Equity Fund, Ken Ryan, joined us now to discuss. Ken, it is good to see you. So, it's a new year, Ken. Maybe I'm looking over my portfolio. Why do I want exposure to international markets, Ken, in 2026 and beyond? What are the big picture reasons?
Yeah, well, thanks, Josh, and really glad to be here. I'll start with the big reason, which international markets were up 30% last year, over 30%. Let that sink in for a minute. Notably outperforming the S&P, and what were really the key drivers of that, very important to understand. It's a variety of themes throughout a number of regions and markets, largely uncorrelated to the U.S. It's the U.S. dollar weakening, and that helping a lot of global companies. And it's starting valuations in general and internationally being a lot lower than the US. And for US-centric investors who oftentimes tend to focus on their home market, tend to focus on the Mag 7, tend to ignore some of these opportunities globally, we think this is very good opportunity. Start of the year, everyone revisits their portfolios, and we have a lot of themes we're excited about, and we really want to make a lot of investors a lot more aware of what's going on in the rest of the world.
What are some of the wild cards, though, Ken, I might need to consider before deploying capital overseas? I mean, would it be, is it geopolitical tensions, Ken? Is it tariffs? Is it rates? Walk me through the broad risks you would see.
Yeah, absolutely. Well, I think, Josh, this is a very important reason to look to an active equity manager and look to a professional manager to watch all the trends. I mean, if I look at the index that we track, there's well over 25 different countries around the world. To your point, there's many geopolitical tensions going on. There's interactions with the US in a variety of regards. However, there's also a fair number of opportunities. And we tend to look at the opportunities. We tend to focus on the opportunities. We balance those with the risks. And if you look at Europe, for example, this is a region that we're just so excited about the infrastructure. And the infrastructure build not only over the next year, but over the next decade. This is energy transition, rising electricity demand. This is Europe broadly, led by Germany, planning to spend over €1 trillion over the next decade building out infrastructure. And there's not only a number of sectors, utilities, industrials, materials, but also a lot of specific companies that get us really excited about the region.
On sticking with Europe, Ken, this was interesting. You point out European banks have outperformed actually the Mag 7 over the last few years. What explains that, Ken? Is that sustainable? And what's a smart way to play that in your opinion?
Yeah, absolutely. You took my stat, Josh, so I appreciate you highlighting that one. So I think the story largely with European banks is you almost had a lost decade from 2010, 2009, all the way through really to 2022. Rates were near zero for most of that period of time. Regulation was incredibly high on these banks, and they took a lot of hits in the global financial crisis. You've seen now 3 full years going into year 4 of a lot of that reversing, and these banks starting to benefit from a lot of that pain they took over a 10-plus year period. Rates have gone up, these banks are being run lean and efficiently, and they're being very diligent with their capital, very friendly to shareholders. So what you're seeing, return on equity, is a measure we follow very closely for a lot of the banks. You've seen a lot of these banks over the past 3-4 years move from mid-single digit, maybe high single digit rate on returns on equity to mid-teens for most of them now, and even trending into the high teens. We're really focused on quality here at Parnassus. And look, if someone told me you have a mid-teens, even high teens return on equity company trading at a low double-digit PE, close to 1x price to book, those are usually the kind of companies we want to look at and potentially own. And there's a lot of banks that meet that criteria.
Ken, let me end here on another thing you point out. Japan, you say at a possible turning point. How so, Ken? Walk me through it. And then how do I want to play that? You know, is the smart way country-specific ETF, Ken, or no, there are certain specific stocks on your radar?
Yeah, great question. So first and foremost, Japan has been undergoing corporate governance reform. They're now probably in year 4 or 5. But to continue on my previous point of return on equity, most companies you met with in Japan 5, 6, 7 years ago, return on equity was not something they actively talked about. It wasn't something they were putting in their presentations. And you contrast with that today, it's in every discussion. It's in every medium-term plan. It's in every target. And the point behind this is Japanese companies with corporate governance reform, they're focused on returns on capital, they're focused on their shareholder base, and they're focused on running efficient operations and really focusing on their core businesses. And in terms of how to play it, we're bottoms-up stock pickers here. We're big believers that you have to look at the specific companies. You have a lot of management teams in Japan that are saying all the right things to investors, but they're not really following that up with action. And what we're really looking for is not only a management team who says they're focused on return on equity, who says they're focused on their core business, who says they're focused on unwinding cross-shareholdings, but the companies that are actually doing that and showing a lot of evidence. So those are the types of ones we have in our portfolio.
Final one, Ken, I just want to sneak a final name in here. Siemens Energy, I know, is a name you like. Why is that a buy?
Yeah, I think the simple answer with Siemens Energy, you have a highly moated, competitively advantaged business. You have demand as far as the eye can see. Their main business, they're completely sold out of capacity through 2030 and beyond. And you have a structural winner with margin expansion opportunity as this demand comes through. So look, Josh, we're long-term investors, 3 to 4 year average holding period. Some we hold longer than that. Siemens Energy seems like one we can hold for multiple years as the company continues to execute, continues to benefit from increasingly relevant product, and really has a margin benefit as that happens.
Ken, appreciate your time and those picks. Thank you, sir.
Thank you so much. See you later.
Coming up, President Trump giving defense stocks some whiplash with his recent comments. We get an analyst take on the outlook for that sector next on Market Domination Overtime. Well, GM just announcing it's taken a $6 billion charge to its EV business, and Yahoo Finance senior autos reporter Pras Subramanian has the details. Pras, fill us in.
Yeah, Josh. So in a filing just after the bell here at the SEC, GM said it's taken an additional $6 billion charge to its EV business, right? This comes after softer demand for EVs and the loss of that federal EV tax credit at the end of Q3. So of that $6 billion, 1.8 is non-cash impairments. 4.2 billion is cash charges for things like supplier contracts and cancellations. GM said this will not affect its adjusted EBIT for the quarter because this is going to be outside of that. So you're going to have that, but this comes on top of the 1.6 billion it already took back in Q3. So you have a cumulative 6.6 billion in EV charges. Also want to note that in the quarter, the company is also taking a 1.1 billion charge to its China business. That's the SAIC GM joint venture they have in China that's related to the moves they made there in China. So a lot going on here with GM, 7.1 billion in total. But if you just look at the EV, it's 6.0 billion for this quarter, for Q4.
In other auto news, while we have you, my friend, Jensen Huang, what's your take on this? He unveiled Nvidia's Alpamayo autonomous car AI model at CES. Got a lot of headlines, made a lot of news. Called it the world's first thinking, reasoning, autonomous vehicle AI. Pras, tell me your thoughts about that. You saw those headlines. I mean, has it kind of compare and contrast to Tesla, to Waymo? Pras, walk me through it.
So with regards to Alpamayo, it's, I mentioned it's the reasoning mix added to their self-driving platform. So, you traditionally have these, there can be some systems that are pretty rudimentary. They're rules-based, they kind of simple, but they can't handle complex things. Now, NVIDIA is adding this Alpamayo reasoning to the mix. Basically what it means is that, you have sensors bringing in input, you have training from the real world, video simulation, things like that the system learns. But now it can also sort of reason to solve a particular problem. Like, for instance, what to do if a traffic signal's out. Right. What now, if you add Alpamayo, what it'll do is it'll reason. It'll show text showing you that reasoning, like an LLM would. Right. I see that this light is out. I should probably stop here, then move, proceed cautiously. So you see that stuff is pretty cool to kind of have the ability to see the reasoning of the system. Now, Tesla's a little bit different. They have an end-to-end neural network. It's all trained on the millions of hours of video that they collect from their drivers, so the system can just see and react to it. It's a black box, right? So you can't really see why or how it made a decision. That was a change that Tesla made. Now, Elon Musk said in response to seeing what NVIDIA did that they do also have reasoning, but we can't really check that because we don't have the ability to check in a closed system, right? So we don't really sure what's going on there. But two different ways to sort of skin the cat here for self-driving, right? Do you want to have a more less complex, a quicker and less computational taxing system that potentially Tesla has in place, or do you want a more reasoning foundation-based model that can solve those edge cases potentially, but it could also take a lot of computational power, cost a lot more money, need a lot more sensors, et cetera. I think you know where this is going, right?
Well, let me ask you. I mean, do you think you saw? What is Jensen's end game ultimately? I mean, would you expect? Okay, he launches his own robotaxi, or no, he sells this tech to others?
I don't think so. I mean, I think a big part of this is what people are excited about is that it's open source, right? All the models, all the information, it's all on GitHub. You can see it. You can actually tinker with it. You and I can actually tinker with it right now if we wanted to, right? But that's still, it still needs to be deployed in the real world. And I think that's why he wants to have partners like Mercedes, which is the first car that's going to get the full Alpamayo stack in it, right? You have GM, you have Hyundai that are going to use NVIDIA's chips, right? So they'd rather build the chips and the modules, make money off that, have your companies like Mercedes, GM, and Hyundai implement it. And you mentioned robotaxis, even Uber and Lucid are partners with NVIDIA, and they're going to be doing a 20,000 unit robotaxi business that's going to be powered by NVIDIA chips. So I think if you're Jensen, you'd like the ability to just keep cranking out the chips and the modules and not get into the business of running a robotaxi company, for instance.
All right, Pras, appreciate it. Thank you, buddy.
Thank you.
Well, big news out of Washington, reshaping the defense sector. President Trump calling for a significant increase in defense spending. Also, cracking down on buybacks, dividends, even executive compensation across the industry. For more, we're bringing in now Tony Bancroft, portfolio manager at Gabelli Funds. tracking aerospace and defense. Tony, it's always great to see you. So let's kind of start big picture here, Tony, because a lot of headlines from Trump. It's kind of a 1-2 punch. On the one hand, big defense budget increase. That's good news. But then he's cracking down on buybacks. He's going after executive comp. I mean, how as an investor do we make sense of all this, Tony? Did you read these headlines? On balance, did you say good news? It's bad news? Walk me through it.
Yeah, great to be with you, Josh. I'd say overall, long term, I'd say this is a strong demand signal. Obviously, in the near term, there's volatility. Obviously, his tweets yesterday regarding executive pay, buyback dividends, those are obviously not, those aren't productive as far as it goes with, the defense industry. But it just shows that I think we need the defense industry primes to, essentially to get these programs on track. And the reality is they're going to need a lot more. They'll restock inventories that have gotten used over the past few years with Ukraine and with Gaza and Israel. So I think you're going to see a lot more of this going forward as far as increase in production. The Lockheed comments that came out the day before, tripling production of the PAC-3 missile. Probably going to see more announcements in the near future.
Well, it is interesting, Tony, because when you read that post from Trump on social media, what he seems to be going after them for in part is like, listen, he says, you're moving too slowly. And I just wonder, as someone who knows the industry, I mean, is that a fair criticism, Tony? And if that's true, what's the reason? What's the choke point? Is it labor, supply chain? What's going on?
Yeah, I think there's always two sides of the story, and I think both sides, it's probably not a great answer, but both sides have a point. I think on one end of the spectrum, you have the defense industry that, making these very sophisticated, technical weapons that have huge supply chains. And then you have the labor side, which is, that highly technical. And on top of that, which is unusual compared to the rest of maybe its peers, industrial peers, they have to have a security clearance on most of these weapon systems. And if you haven't ever been through a security clearance process, you'll quickly realize once you do how long it takes. And again, it's like fine wine or whiskey. You can't speed up the aging process, and it just takes time. And that's been an issue, since the defense industry has really formulated, and you've seen it, particularly on the Air Force One program, amongst others. And I think that's going to continue. And then the other side of it, of course, these are oligopolies. These are very consolidated industries. And a lot of them are sole source, so they hold a lot of, they carry a lot of weight. But then again, at the same time, it's a monopoly where you have one customer, and that's very unusual, I'd say, in a sector or an industry. And these guys want to keep their one customer very happy and a follow up and improve. So I think you probably have a little bit of both on each side, and all things being equal, the demand's there, the know-how is there. And I think in the long term, they're gonna get this figured out, including Raytheon, which is one of our large positions in our the commercial aerospace and defense ETF, ticker GCAD, amongst other primes and tier 1, tier 2 suppliers, and they're gonna I think benefit from this in the long term.
Well, let's end here with some places where you do see opportunity, Tony. Why is Albany International a buy? I mean, it's down about, it looks like 30% over the past year. How come that's a smart place to commit capital?
Yeah, our Albany is one of our largest positions. We see that as essentially a sum of the parts story. They've got two businesses: a business which is nothing related to aerospace and defense. It's called a machine clothing, which they actually make the belts that make paper and pulp products. And it's a great business, but it's not a lot of growth, relatively high margin. And if you take that business alone and essentially net out the net debt, essentially that's the market cap of the company right there. And then you essentially get the aerospace business, which they use the technology from this machine clothing, these belts that they've learned to produce at a very effectively, and use this thing called 3D weave, carbon fiber weave, and they're able to make fan blades for commercial planes, and they have a large contract with Safran to supply fan blades for the 737 MAX, the LEAP engine. and the Airbus 320. That's a huge backlog, huge contract, very profitable and long legs on it. So you have these two businesses. It's probably a subscale on each one, and I think eventually they're going to get these programs in line. They've got some other things that are going on as far as defense contracts. They'll probably be able to fix those, and I see it as it's probably going to be a double or more in the long run on a sum of parts basis.
Tony, always great to have you on the show. Thank you, sir.
Okay.
Time now for To Watch Friday, December 9th. We're going to start off on tariffs. Possible ruling coming on Friday from the U.S. Supreme Court. That's for President Trump's use of emergency powers to impose sweeping global tariffs. Case centering on whether the White House overstepped its authority by using a national security law to levy broad import taxes. Odds-on prediction market Polymarket say there's a 25% chance the Supreme Court rules in favor of Trump's tariffs. Moving over to the labor front, the December jobs report coming out on Friday. Economists forecasting the U.S. economy to add 70,000 jobs, while unemployment slows down to 4.5% and hourly wages tick up to 0.3% on a month-over-month basis. And taking a look at the Federal Reserve, we're going to be getting some fresh commentary on Friday from Fed Presidents Neil Kashkari and Tom Barkin. It's coming after from comments from Fed Governor Stephen Moran. Moran saying that the central bank will need to cut interest rates by more than a percentage point in 2026. And checking in on the consumer, fresh data coming in on Friday with consumer sentiment. The January number expected to rise compared to last month to 53.5, signaling that consumers are feeling slightly more optimistic about the state of the economy. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.